Good evening and welcome to this regular webinar series from myself, Charlie Burton, in conjunction with Tickmill. And so tonight's webinar is on divergences and multiple divergences. I've been trading divergences for probably 20 years out of my 27 years worth of trading now. So I've probably been trading them for around about 20 years, and they are a stable part of my trading. So before I go into all of that though, and I'm just going to do the usual risk disclaimer, as I am presenting in conjunction with Tickmill, a multi-asset broker. Here's your usual disclaimer slide here, like we all have with regards to trading material. All of this trading material is not considered to be investment advice. The views and opinions of myself, if any, are expressed, then they are my opinions, not that of Tickmill. Okay, so we are going to, this evening, go straight to the charts again. Much like last month. In last month's webinar, we went straight to the charts. We're going to be doing that tonight. But before we do that, I'll just tell you a little bit about what's coming. So, and one thing to mention, I must mention with Tickmill is if anyone here has not got an account with Tickmill, here's a link so that you can open an account. You don't have to do anything. You can just go through the process of it and then start on a demo account or whatever. So by all means, give them a try. They are a great broker. I've been dealing with them now for the last, probably the best part of the last 18 months. And my experience with them has been very good. And so I would highly recommend you checking them out if you're not already got accounts. Okay. We're going to go straight to the charts. Tonight's webinar is, as I've already said, is about divergences. What I'm going to be going through are the fundamentals of how I trade divergences. There are many different types of divergences out there, technically in the markets, but I'm going to be showing you just some of how I trade them. So, and you've got to bear in mind, I'm going to be trying to squeeze about 10 hours worth of content into around an hour or so. So we're just going to see how we get on. And this is certainly going to be one that you're going to want to re-watch after the fact, because it's one of those sorts of patterns that you have to get your eye in for. Most people, when they're learning new patterns, it takes a while to get their eye in. Some traders will pick it up straight away. Others will be like, oh, Charlie, not quite understanding that. I'm not quite seeing that. That all I'll be able to say in response to that is please watch a rerun, because like I've said, we're time poor here this evening. I've got plenty of time on the evening. I can run for an hour and a half, but even that wouldn't be enough. So I'm just sort of setting this up. So I'm going to be running through how I approach them. I'm going to go through the basics of the pattern itself, and then we're going to build on that. I'm going to go through the background analysis and trends that you can use with divergences. A lot of people assume that, yes, good evening. I'm sorry I can't say hello to everyone as they come in. A lot of people assume that divergences are purely counter trend. And so I'm going to dispel that myth here this evening as well. We're also going to be talking about overlaying multiple divergences in a single market, and also divergences on multiple markets as well. So we'll be going through that here tonight as well. We're also going to be look at the use of targets in relation to these divergences, which can really provoke really lovely risk to reward profiles. In fact, I'm going to show how you can end up with divergences and trading divergences and getting risk reward profiles of multiple R figures. Thank you, Johan. Jotham, sorry. Right. Like I've said, one last thing. This is a more technical session here tonight, and so If you're not following along, it's absolutely fine. I wouldn't expect you to be able to follow along with everything, because I'm going to be going through at a bit of a pace. And so by all means, get hold of the recordings. I've just said Tickmill are building a microsite for me. And on that site is going to be all of my the historic webinars that we've done together, that I've done with Tickmill. So that's really nice. That's going to be up and running in the next 2 to 3 weeks. It's currently the 23rd of May. So I've been told about that. It's just going through the developers putting it all together, and then it just has to be run by their compliance department and all those usual things. So you will have a microsite. I'll be able to give you the link next month anyway. We've got another webinar coming up next month. And so you will be able to go back over and watch tonight's recording. Right, let's get into this then. So let's get rid of the charts and the screenshot and bring up the charts. So what I'm going to do first of all is I'm just going to use a pen. I'm going to take some trend lines off of that chart. We're just going to put that to the side for a moment. So the divergences that I use, I'm going to go through my settings on my charts and everything. The divergences I use are using a straightforward MACD indicator. The straightforward MACD indicator with the standard settings of 12, 26, and 9. That is the standard setting, default setting in your charting package. Whatever charts you use, they will usually default to 12, 26, and 9. Okay. If you use, just as a warning, if you do use MT4 for your charting, the standard MACD setting on MT4 is incorrect, because it's MT4. It's a cheap piece of software. It's a very good piece of software, but it's free, and the MACD setting isn't great for it. I do have a download for MT4. So if all you use is MT4 for your charts, do let me know. And at the end of tonight's session, I will scrabble around and find that download for you and figure out a way of getting it to you. Maybe we'll get it put onto the micro site that we're having built. Anyway, so 12, 26, and 9. So what I'm going to, and what I do with the MACD itself is I use the, because the standard MT4 setting for MACD is no good. So I've got the plugin, basically a plugin, and that's fine. Okay, so I use the MACD lines. Yeah, that's absolutely fine. Let's not get confused. That's absolutely a good thing using MT4. It's a good platform to use. I'm talking about the charts in it. They're free, and some elements, a lot of the charts are absolutely fine. But the MACD indicator, the standard one, if you just pick it off the standard MT4 list, it's no good. It's not correct in its settings. I've got a correct setting. You can then just upload it into your MT4 and away you go. I will get it to you. You're just going to have to be patient. Once it's on the microsite, I will give it to the web developer and we'll get it put onto the microsite. Okay. Right. So, I use the MACD lines. I do not use the histogram. So I don't use I have no need for the histogram. I just use the MACD lines. So what we're looking at is something like this. So this is, first of all, what we're looking for when we're looking at a divergence. Now, divergences come in all sorts of shapes and sizes, but this is what essentially we're looking for first of all. Now, one thing we're going to put a lot of overlays onto this evening. So I'm just going to show you what a divergence looks like first of all. Then we'll go back to the price action, because price action's all important here. Price action comes first, and what the price is doing. What a lot of people, whether they make a mistake, is their eyes go down to an indicator, and they're looking at the indicator first and ignoring what's going on the chart. So, but for now, I'm just going to be going through the indicator itself. So the very nature of a divergence when we're using an indicator is that price itself comes down, makes a low, bounces a bit, make it come over a bit more, and makes a new low down here. So at point number 1, over here, the MACD line itself has made a low here. At point number 2, as we can see, although price over here at point 2 has gone lower, the MACD line is diverging. Okay, that is simple in its concept. Although some people here may have never seen something like this before, but it is a simple concept which I suspect that everybody here will at least understand this concept. So can I just double check everyone's okay with that? So you've got points 1 and then you've got points 2. 2 in price has gone lower than point 1, but the indicator is not moving with it. It's going in the opposite direction. Yes, great. Okay. Right. And it's exactly the same in reverse. So I'll, good stuff. I'll just put it in reverse. So we have a high in the indicator and then we do something like this. And this time we've got price coming up, makes a high. So it's the exact opposite of what I've just shown. Pulls back, comes up, makes a new high. So this is now our point 2. Point 2. Here's our point 1 here. Here's our point 1. Because I'm going to show you lots of examples tonight, but I'm not going to be able to go through the basics of it over and over and over again, like I said, because this is 10 hours worth of content I'm squeezing into a webinar tonight. So point 1, price made a high here. It's pulled back. It's made a new high into point 2, but the MACD itself is making a lower high at that point. Now, one thing that we need is, again, I'm not going to answer questions on RSI, why not RSI and MACD. Please, I need to keep this flowing. So this is, MACD is what I use. You can use RSI. Absolutely, you can use RSI. But this is all about using MACD because that is what I use. There are other ways of finding divergences with other indicators. That's not what I use. I'm here to show you what I've been using for the last 20 years. Okay. So points 1 to 2, we've got divergences. Yes, that's right. Yeah. So now, one thing at point 2 is, well, how do we know that at point 2, the price doesn't just keep going higher? So we need something that goes on with price over here in this zone to at least give us a heads up that, price might, start to roll over here. So we'll be going through that as well. But overall, you've got the basic pattern. Good. Right. Let's move on. Now I'm going to go to the chart. So on the chart here, I've got the MACD indicator in the bottom window. Now you can say, well, hold on a second, Charlie, you've got 2 lines on here. Yes, I have. So I've got the MACD line and the signal line here. So where you get, a lot of the time you get crosses. So we're going to talk a little bit about that. The blue line is the most important. That's the MACD line itself. So we're going to be looking at that, but we will also be looking at when it comes back down to its signal line as well. So that's the indicator at the bottom. I've deliberately already taken off the histogram because very often when you have an MACD indicator, it will plot both the histogram and the lines. So for the purpose of this, because I don't need the histogram for this, I've removed it deliberately. On the price chart itself, I use candlesticks. So I've just got candlesticks on there, and I've got 2 moving averages. I've got the black moving average is a 50-period moving average, and the green moving average is a 100. Now, they are what are going to come into play with regards to targets. So, and really, it's only going to be the 100, but I'll leave the 50 on because the 50 is something a lot of people use a 50 period moving average, and we'll just leave it on anyway. So what I'm going to do is I'm going to start off just looking at a few examples, and I'm starting off with a really high time frame stuff here, going out to a monthly charts. I'm going to go out to quarterly charts, and then I'm going to start bringing it down to smaller time frames, and we're going to come all the way down to intraday time frames. Okay, but first of all, I need to show you some of these divergences. So hopefully you can already identify. There's a point 1 here. Price has made a low here. Price then made a new low. This is all back in 2017 down here. So this is our point 2, and the blue line is now quite clearly higher at point 2 than it was down here at point 1. Now, what was important here for me is that the blue line between 1 and 2, as price bounces before, and then of course as it rolls back over, I want the blue line to come back and touch that signal line. Okay, I want it to come back and touch or cross back through it. Either way, I don't care. I want that blue line to come back down and touch the signal line, and that's why I keep that yellow line on my chart here. So, but the basics are that at points 1 to point 2, is there a divergence? Yes, there is. Right. Okay. So this is on the monthly chart. Now, I'm here to talk to you about all sorts of divergences here tonight. Divergences which are going counter trend, which we can certainly make a case that this divergence down here is going counter to the overall prevailing trend. I'm also going to be showing you this evening divergences which occur within a trend as well. So, but for now, we're just going through the basics of what they look like and how I end up using multiple divergences. So at this point in 2017, what had actually happened? Well, and this is what brings me on to my next point. One thing I find with traders is that they pick up a pattern and then just want to trade it everywhere. So whereas what we really want to be doing when we're trading is to be trading into prior levels, prior support, prior resistance, into areas of supply, demand, whatever you want to call it. And we don't really want to necessarily be taking every single pattern out there. This is why I said, you don't go to the indicator first. You analyze the chart first and then say, if price comes down into this zone down here, and we then get a divergence, I'm going to be interested in that on the long side because that's a bullish divergence. Because at this point, when price has come down to the whole 105 zone, it actually clipped 103.5 back then in the beginning of 2017. What was it actually doing? Well, as we can see on my chart here, it was into what? Prior price levels, going all the way back. So as it came down, now at this point, it's just making the first low. So it took another 2 years before this, on the monthly chart, before this actually developed. I traded this divergence. Some of you here tonight probably will be aware of that if you've known me for a while. So it's not just trading it just because there's a divergence in this window down here. No, I'll put a tick in there, but it's not because of that. There has to be a reason on the chart to say, well, yeah, we're into a really good price level here and we're setting up a divergence. So analysis comes first, is my point. Analysis first. So the way to use divergences is to analyze a chart first and then analyze a chart and then say, right, if price comes to this level or this zone, or to that zone, then I will actively look for divergences. That's the way to do it. Top-down approach. Analysis first, chart first. Otherwise, what people do is they just look for divergences. And they're always, oh, there's a divergence there, I want to trade it. Well, and then they try and curve fit it to the chart. So you're better off analyzing a chart on whatever time frame or time frames you like to trade off of, and then say, right, okay, as price moves into, this area of resistance or supply, or this area of support or demand, okay, if I see a divergence down there, then that may set up a nice trade potential for me. Okay, I think I've made my point there. So back here, zooming back in a little bit, we did get a divergence, and it actually started right at the beginning of January in 2017. And what happened next is, yes, price ended up going higher. I carry on clicking up, and it ended up, and I've got to go through a load of trade criteria with you yet. At the moment, I'm just talking about the pattern itself. So as price started coming up here, like I've said, I used the moving averages as targets. So it did eventually get all the way up to that 100 moving average up there. But again, this is a monthly chart. You wouldn't have necessarily tried to hold on to a trade all that time, because that's a very long time to be holding on a trade, and you might have swap fees building up and all of that. Right, there we go. That'll do. So why do I have both these moving averages on here? Well, if you want to trade this in a very mechanical way, so you've done your analysis, you've identified this whole support zone down here. Price has come down into the support zone, and then what's important is we've then had a nice strong up bar. Okay, we've had there. That's the first key that we're looking for. A nice up bar. Okay, I'm going to talk through the exact entries that I use a little bit further into this. So you've got your up bar that's given essentially a buy signal, but just hold that thought for a moment. So the 100 is the target. Okay, years ago I actually used to use the 50 as the target, and you can do that and just use a 50 moving average as a target. But I subsequently found through testing that actually the 100 is more profitable holding on for longer. Now, you don't have to use moving averages as targets. You can go off and test this sort of thing and put your own targets in, whatever sort of targets. You could use a fixed target, whatever. You can use your own targets for this. But I'm just showing you what I have historically used. So the point nowadays, what I would do if I was mechanically trading this, even if I'm targeting the 100 up there, is when it does get to the 50, is to move the stop loss to break even at that point. So stop loss to break even once price gets to the 50. So stop loss initially is down at the lows down here. Stop loss gets moved to break even at the point of price hitting the 50. And then, if the 50's been a long way away and it's a really good run, you've got flexibility to bank partial profits. You can do whatever you want. I'm just showing you what I do, and have done historically with this. These are simple moving averages. Thank you. Yes. Yeah, thanks for asking that one, actually. Yeah. So, stop to break even at that point, and then this is the target at the 100. Okay, simple stuff at the moment. I'm just teaching this at the moment in a mechanical fashion. What I'm going to do is show how this works, how you can use this in multiple ways as we go through this. Okay, so is there anything else I want to mention here? No, that's all fine. Now, like I've already said, that's off a monthly chart. So there are different ways to... At what moment did you go in the trade? Because what you show was already into the future. Yeah. I've already had it. Remember, back in real time back here. So I'm gonna explain that right now, Johan. So, like I've said, this is on a monthly chart. So I've got to wait. The euro made that low at 103.5 at the beginning of January in 2017. All right. There was massive negative sentiment towards the euro dollar at that point. Everyone was calling for what? Parity at that stage. So from a sentiment perspective, we were actually at quite an extreme in sentiment. Everyone, all the talking heads, Reuters, Bloomberg, you name it, all of the analysts out there and journalists were talking about euro going to what? Parity. And as most of you know, when everyone's talking about the same thing, it usually doesn't happen. So at that point down there, we've got this developing divergence on the monthly chart. But in real time, I would have had to have waited until the close of that bar there, that green candle, which would have come in at the end of January, which would have meant that, I would have had quite a wide stop, and that's fine. If, relative to the target, you can see that it would have been a good risk to reward. In fact, let's go and have a look at it. Let's put the risk to reward. I can put it on here. That's a projection. I think this is it. So drag that up to there. Let's just move the chart around. Let's move that stop loss, and that's up at the low there. So that gives a solid risk to reward ratio of just under 4. Okay, so or 4R, however you measure it, it's all the same thing. A 1 to 4 risk to reward ratio, or 4R, roughly speaking. Then okay. However, can't we use? Look. As I've said at the beginning, I'm going to go through all of the time frames from high time frames right away through to intraday. So just bear with me. You've got to just be patient. Wait. I know that you're getting ahead of yourself. I'm going to go through all of that. So this is on the monthly chart, as I've said. So, well, what was going on the smaller time frames? Well, okay. So let's go down to the weekly chart. Now, at that point, I'm just going to reset the scale here. If we take the weekly back to, there we are, 2017, this was that low coming in right there in the January. Was there any divergence? No, there wasn't. Okay, so there was nothing on the weekly time frame. I'm just going to flatten the price at that history there because I'm going to go to the daily time frames now, and we're going to whiz this back on the dailies all the way back to 2017. So I'll just use the go to, might as well do, change the date there, 2017. Okay. Now, what was interesting, I've just shown you what was going on the monthly chart at that stage. Hopefully you can see that coming right away in to that beginning of January of 2017 down here, I've shown you what was going on the monthly, but you would have had to have waited till the end of the month in order to take a trade, in order for that candle to close. But what was actually going on here on the daily charts? Oh, we had a divergence also on the daily charts. Price made new lows, but we've got this divergence here down here. So this is where you use multiple time frame analysis. So you've already analyzed on the higher time frame. Oh, right, yes, there's a divergence building. At this point in real time, we know that there's a potential divergence building on the monthly chart. Well, that's fine, but I could wait until the end of the month. But in fact, I can get in down here on the daily chart and then still run the trade based on, if that monthly starts to kick in. So by the time we got to the end of January, price is already up here. I can then hold on knowing that we've got what? That that monthly setup in place. So that then gives, what's that, an entry roughly? And I traded this. So I was in, there were even divergences on a 4-hour chart back then. So I was trading, I was going right away down to a 4-hour time frame. I was in a little bit earlier down here. But even if you use the daily chart here, got an up bar here at 104.87. So if I now take this back to the monthly, okay, 104.87. Put the position calculator back on. 104.80 odd. So it was about, and it was right back here. I'm just looking on the side there. Okay, roughly there. Drag that right the way up now, back up to the low, and then drag that up to that 100 by using multiple time frames. So I've got the monthly chart as my base, as my main headline template, knowing that, oh, okay, this has got, has got that opportunity to run all the way to that monthly 100 moving average up there. But I'm actually going to capitalize and get an entry earlier based on the daily divergence. And by getting on the daily divergence, my risk to reward now is what have we just seen there? 13.7. So nearly 14, 1 to 14 risk to reward ratio. And this is how you can end up getting some really good risk to reward ratios based on using multiple time frames. And we're going to be showing you more and more examples as we go through this here this evening. Everyone okay with that? So we've got the higher time frame template saying, right, well, once that divergence is in, so to speak, I'll get rid of the long tool now. Once that divergence is locked in and we've had, a nice green candle there, right, okay, well, that gives us, a projected target potential right away up here at that 100. Good. Okay, Blair. So we've got that right away up there at the 100. But we can couple that with what's going on the smaller time frame and say, well, okay, daily chart, there's a divergence. We're getting off the daily divergence. If then this monthly bar locks in, great. We'll then run the trade based on the monthly, in theory. Obviously, like I've already said, that this is a theory trade of holding it all that way because, I don't know what the swap situation would have been like at that time. Now, because I can't remember what the interest rate differentials were at that stage. If the swaps weren't a problem, then you could just hold it all the way. If there were swaps to be paid, then you probably wouldn't. You would just trade in and out of it. So you would use it as an overall template saying, right, okay, on the monthly chart, we've got this divergence here on the monthly. I'm going to get in based on that daily. And overall, it should work its way up in the end to the 100 right up there. It's got a good chance of getting up to that 100. So what I'll do, though, is I'll trade in and out of it. Yeah. And so use it as a template for trading in and out of. So, yes, I'm going to come to that, Alan. Yes, good question. Why did I choose 2017? Because I needed to find an example. I'm just using, that's the first example. I've got lots of examples for you here tonight. So it's just an example. I'm going to be using a lot of recent examples. The reason I'm using this 2017 example is because it's off of a big time frame, off of the monthly. So I want to show you that as a, because it is off a bigger time frame. And then I'm going to show you other examples off of smaller time frames as well. Right. Thanks, AJ. So, okay. So I think that's enough on that one. And so you can trade in and out of it, just saying, well, okay, I'll have runs going back to the daily charts and if I can go back all the way to, I need to go use the go-to tool again, go back to that, going back to the daily charts. And, you can trade in and out of it, but overall have a much wider or further away target to saying, well, okay, we've got a big picture going on here at the moment. I'm not going to just sit on my trades the whole way, but I can trade in and out. Every time we get a pullback, I'll be looking to buy, blah, blah, blah. Okay. Right. So using that template. Okay. Now what I'm going to do is we're just back on a daily chart here at the moment. I'm going to go to a quarterly chart, and this is important. So let's take these trend lines off. So on the quarterly chart, this is happening right now. Well, over the last 2 years, because this is a quarterly chart. Each candle is 3 months long. And I'm going to then go back to the smaller time frames. So what we can see is, here's our point 1, here's our point 2 over here. So point 1 now is what was going on. Funny enough, that was 2017. That was that low in 2017 now. So we've now got, when we rolled over into 2022 here, into the lows of October or late September of 2022, price has gone lower, but we've diverged again. This is on a quarterly time frame. Where's the 100 moving average? Oh, it's right up near 120. Okay. I'm going to come back to the setup in a second, Alan, as far as identifying an entry candle. What I've been trying to do at the moment is just show the pattern, just showing a few examples, and then we'll start introducing some extra stuff, and then yeah. So on the quarterly right now, we're still midway through this divergence trying to play itself out. The euro over the last, it's had a lovely up run off of 0.2 down here. And it's gone a bit sideways here basically over the last year, as the dollar's got a bit sideways. But it's still in the process of trying to work its way up there. So right now, that's where my analysis is. That in the long run here, on the big picture, I'm looking for long side trades. Okay. So I can use that information, just like I showed back in 2017, saying, well, the monthly chart, there was a divergence, but we actually got in off of the daily chart. Okay. Well, now we've got a quarterly divergence. Well, what's been going on through all of this here? So let's have a look through all of this and find some examples. So we know that the much, much, much bigger picture is looking for more upside. But that doesn't mean to say that in the short term that price isn't going to go up and down or whatever. So that's just a template now for the foreseeable, So let's now go down to the smaller time frames and see what we can find. So this is I've now taken us to the weekly chart. Now on the weekly chart, that was that low that we've just talked about on the quarterly, and we've come up since then. That was late September of 2022. So this is that move that we've just seen on the quarterly chart, and you can see that the euro dollar's got a bit, overall sideways. The dollar itself has got a bit sideways, but ultimately, as far as that big picture divergence is concerned, I need to be keeping an eye out for a breakout in that direction at some point. But even before a breakout, could I be using divergences again in that direction? Well, let's have a look. News doesn't have respect for divergences. No. These are technical patterns. News is always going to be the news, and news will always move markets around. But that doesn't really matter if you're technically trading. News is always going to do things and move the markets around, but the patterns are the patterns. So that doesn't make any difference. Okay, so let's now come down to the daily chart, because I've just shown, if I just zoom out, so you can just have a quick see that, okay, that's that low that happened in 2022. And this is where we are at right now. Okay, so you can just get a sense of where the euro is right now and where ultimately it might be going, into the future. Okay. So what I want to be doing is looking for trade setups in that overall direction. Now, I can trade on either side, and I have traded on either side. I actually traded this move down in late 23 last year, from the summer of last year to the downside. Why? Why did I trade that downside? Well, funnily enough, for a while there, if we zoom back in a little bit to that high, take us out to the weekly chart. That is that high. What went on? Oh, funnily enough, we ended up doing a divergence down here. 0.1, 0.2, 0.1, 0.2. Oh, we had a divergence. So there were other reasons, but I'm just trying to keep it as simple as possible here. So we had a divergence there. So I did have a bit of that clip there last year as well. So divergences will happen on either side. So taking us back to the daily charts, let's now have a look at what's been going on overall. So we're going to start off with this low over here. Bearing in mind, like I've already said here tonight, I'm interested in trading when price comes into a meaningful level. So, for example, when price came down into October of last year, I'd been on the short side, remember, all the way down here, or say all the way from about 110 down to about 106, I think, is where I exited. But what happened was, bearing in mind, I already know that we've got big picture divergence in the background on the quarterly chart. So that's at the back of my mind anyway. So I'm looking for what? Long side divergences to get back on the long side. So as prices come down into all these prior price levels, okay, we've got a technical area of potential support or demand, whatever you want to call it. Okay, there's no divergence down here. All right, there's no divergence on the daily charts. However, all I now need to do is go back and go back down to the likes of the 8-hour chart, and I need to just zoom us back a little, just quickly. Take us back to the 8-hour chart. Here we go. Oh yeah, right at that low in October of last year. At that point that we were coming down, what did we do? Oh, we've diverged down here on the 8-hour chart. In fact, we also diverged at the same time, scrolling it back down here, on the 6-hour chart as well. So we're now getting multiple divergences down here. I was trading this with my traders. So multiple divergences, 0.1, 0.2, in line with the analysis overall. Big picture, support zone, technical support zone. Need to have that as well. We don't just trade any old divergence. We've got the big quarterly divergence in the background. So I'm looking out for divergences. We didn't have any on the daily charts at that point, but what have we got? We got some divergences kicking in here on the intradays, 6-hour chart, 8-hour. I can't remember if there was on the 4-hour as well. Okay. So this is where it really starts to all come together, and you can say, oh, right. So find support, find resistance, and then look and see if there are divergences coming in that zone. So let me just take this back again. I'm back on the daily chart. So back down at this low down here, and in that 104, 105 zone, although there wasn't a divergence on the daily, we had multiple divergences on likes of the 8-hour chart and the 6-hour chart, and maybe even the 12-hour chart. I can't remember now. Yeah, we need to see previous support or resistance. Exactly, Ryan. Yeah. Now, I want to come back. I'm just going to come back to Alan's question. Alan, I just want to make sure you're still there. Hopefully Alan's still there. Good. Well, yeah, so we need that sign. What sign are we going to use in order to, like I've talked about having an up bar, all right? So what's the rules? What do I use? So what I use, and I'm going to put them on now, I use actually, I'll just draw it on first of all. I use two 5-period exponential moving averages. One set to the high, so they're 5-period EMAs. One set to the highest price and one set to the lowest price, okay? So most moving averages, when you put them on your chart, they will default to the closing price. So it'll take all of the closes, exactly, Irish. Nice to see you, Dan, Irish Dan. So they will default to the closes. So what you do when you go to your chart settings, you change the default setting. So let me just go and put an indicator on. Let's go and put a moving average on. Moving average exponential. Okay, I think it's just done it. Right. So if I just bring this up, I think it's defaulted to it. EMA. Right, let's go to the inputs. Okay, so let's change that to a 5. You see the source is the close. So it will default to the close. I don't want it on the close. I want it set to the high. Right, there we go. So I've now put one moving average on there, set to the high price. And now what I'm going to do is add another one. So the indicators, and all charting packages will do this. MT4 will do this. So moving average exponential. So it's the only exponential moving averages I actually use, these ones. All my others are simple. Change it to a 5. Change that setting to the low. There we go. So I've now got on my chart what I call my bands. Okay, Joseph. So what I call my bands. How are we doing for time? Okay. So one moving average is tracking the highest price of the last 5 bars because it's a 5-period moving average. So it's measuring itself against the highest price of the last 5 bars. The other one is measuring itself or creating a new line for the moving average based on the lowest price of the last 5 bars. And that's what creates the bands. So what I do is coming back to divergences. When I can see there's a divergence coming into play. So actually, let's go back to let's just go back to that 8-hour chart there. So let's zoom it, take it back. Where was it? Okay. So when we had this divergence here, down here. So if this was just on the 8-hour chart, actually, it's not the best of examples, but anyway, never mind. I'm looking for a close back inside in between my 2 5 EMAs. That's what I'm looking for, Alan. As it happens on that bar, it didn't only close inside the bar, the 2 5 EMAs, it went the other side. Let's go to the 6-hour, see if that one gives a slightly better example there. There we go. Right. So I would have got in, no doubt, absolutely no doubt, when I traded this back in October of last year with my traders, we would have got in, we'd have seen the 8-hour developing, we most likely would have been getting in, I say no doubt, I 100% no doubt would have got in down here. So you can see price close back fully inside the 2 5 EMAs. That's my setup. Stop loss at the low. Right, now let's go back to that example from 2017 on the daily chart. So I'm just going to go back now. I'll change it back to the dailies. Go back to that example when price made that low in 2017. Right, okay. So when price closes back inside the bands here, right, that gives the entry. Now, what was funny with this is there'd already been an entry. There had already been an entry back here. Price actually closed inside the bands back here, as you can see. Stop below the low. This back in 2017, I was trading this, or that was back end of 2016. it started running quite nicely, had a lovely move up, spiked up, came all the way down, stopped me out here. Stopped me out. We're still diverging. Okay, I'll go back in again. And so I went back in during that day because there was some 4-hour divergences back then as well. But even if I was waiting for the daily candle, I'd wait for that daily bar to close. Closes inside the bands, right? Reset, stop at the low. Yes, Dan, I'm going back to the recent examples. I'm just showing the setup now. So I've got loads of recent examples. I'm coming to them. So now, some of you might say, well, do you have to have your stop right at the low if you just get nicked out, like in that example there? I'm deliberately showing this example. I'll come back to your question on backtesting in a bit, but yeah, how did I backtest? Manually. Yeah, manually, bar by bar. It takes ages, bar by bar. Nowadays, I have software that I use to backtest, but manually, bar by bar is the only way to do it. So yeah, and I've been trading these, like I say, for the best part of 20 years. So so as an option, you can just say, well, I'll have a wider stop, and I've backtested this. I've backtested having wider stops, so you can do that. But I like having a relatively tight stop down, like at the low. If I get nicked out and then it resets, well, just go back in and take the trade again. I'm okay with that. But some people don't like to have a slightly higher win rate, so they can say, well, I'll put a 2 times average true range stop at the low, or something like that. That would be a typical sort of thing. 2 or 3, so my stop loss is further away. Yes, but then your risk reward isn't quite as good. But, each to their own. They're all profitable. I've looked at all of this. Doing it this way is profitable as well. It just alters the risk reward. Anyway, I'm going off on a tangent. Yeah, manual backtesting is hard work. You should, and one of my pieces of advice for manual backtesting is only do maybe up to 2 hours worth at a time, because you fatigue and then you're more likely to miss stuff and make mistakes. And that is the vulnerability of manual backtesting. But the thing with manual backtesting is you get to see everything. It's all very well saying, I'll just put it into a program and backtest it, but you don't see anything. You just get a sheet at the end saying whether it was profitable or not. I'm not convinced by that. If you're going to be trading this stuff, it's good to manually go back and scroll back and do it bit by bit. Yeah, it's a bit hard work, and just do it in clumps of time. If you sit down and say, right, I've got a whole Sunday, I'm going to sit here for 10 hours backtesting, what will happen is you'll mentally fatigue. So either you've got to make sure you take lots of breaks, because you'll start missing little bits and you don't want to make mistakes in your backtesting. Okay, so I'm just going back over that to give you the idea of the setup. Right, now let's bring this all the way back forwards again to go through the recent examples. So I've just gone for a recent example back here. Mine's my own, Adrian, so it's my own software that I have. It's not a commercial, it's not a freely available software. But you can use, you can program within TradingView. So within TradingView charts itself, you can program for backtesting. Anyway, so we've got that example back there. That example, now by itself, bearing in mind, that example I've just gone through from the October lows here, which set up off the 6-hour chart, the 8-hour chart, maybe off the 12-hour chart as well. They more than played themselves out. Because on the 6-hour chart, I don't know where the 100 moving average was, but it was obviously would have been lower down than what was on the daily. So they have more than played themselves out. They've gone to all of their respective moving average targets. What you can do, which is what I do, is say, well, okay, I'm going to try and run this based on, my other analysis. So I'll run trades based on my other bigger picture analysis. So you can use divergences to get into a trade, but say, well, actually, I've got some other analysis which is looking for this euro dollar to come up to this zone, let's say, whatever. So what I'm trying to say is you can personalize it. I'm showing you how I've used this, over the years. If I'm mechanically trading it, as I have done in the past, just saying, well, I'll just run it for the 100 moving average. Nowadays, I don't tend to. I'm usually incorporating it within my overall analysis. But this is a good starting point, is to run it to the 100 moving average on the highest time frame where you've got the divergence. So if you've got a divergence on the 6-hour chart and the 8-hour chart and the 12-hour chart, let's say down here, I think there was one on the 12 as well, then you get into the trade off the 6-hour chart, because that's going to give you the very best risk-reward profile, and you run the trade to the moving average on the 12-hour chart. Yeah? Lots of stuff going on here tonight. Right, let's go further. So because the euro then did a pullback back here into the earlier part of this year. So actually, I digressed. No, I need to go back one. Within this trend here. So, and I've talked about trading divergences within trends, and I'm going to talk about those right now. This is a nice example. So we've got the divergences off the lows down here, off the 104 lows we've already talked about. Then the euro dollar started having a bit of a trend here on the daily charts. Did a bit of a pullback here into what? Early December of last year. Into what? Prior price levels here. So it's pulled back into prior price levels. It's pulled back into moving averages as well, onto the 100 itself. So it's pulling back into a support zone. Those of you who use Fibonacci, maybe it did I don't know, maybe a 38% or 50% retracement. I don't know. But it's pulled back into a prior, price zone at this point. So what was I doing at this point when it was pulling back into this price zone? Okay, let's go and have a look. I'm going to go straight there because I remember a lot of my trades. This was from December of last year. Okay, let's go and have a look. It was diverging at that point as it came down into that price zone on the hourly chart. Okay, so I'm going to go to the hourly. I'm going to go take the chart back to 2023. And actually, let's just bring it. What do we say? December. Okay, let's do it. Okay, so as price on that daily chart is just a pullback, the hourly chart looks like obviously it's a downwards trend on the intraday chart here. But what was going on down the bottom? Multiple divergences, building. And as price then finally got down into that price zone that we've just talked about on the daily chart. So we got the price coming down into that support zone on the daily chart. Then we're going down to the smaller time frames, looking to see if there's any divergences. Multiple divergences on the hourly time frames down here. So guess what I was doing? Yep, I was buying over here when price closed back inside the bands, stopped below the low, and that was the run that it had. Now, in this example, if you're just trying to run it to the 100 on the hourly chart, it's nothing. It's not worth taking the trade. So you're looking to trade it on the and run it based on the higher time frames. But that was another example. Going back to the daily chart now, taking it back to where we were on the daily. That was what was going on at this point into December of last year, and what a run again price had off of that. You could have just run it up to that high and just said, oh, okay, well, it's coming to support on the daily chart. I'm using the divergence. What should I run it to? Oh, I'll run it to that high. Okay, let me go back, see what the entry was. If I go back in time again, what was the entry? Roughly down there. If I just zoom out, right, there's that prior high. Let's put that projection tool on again. Just trying to get this right. Long position, so roughly would have been around about there. Stop loss at the low. If you were targeting it up into that price zone up there, it gives a comfortable 5R or 1 to 5 risk to reward. And so time after time after time, you can couple up divergences with your analysis, taking this back, to identify trade opportunities. And fun enough, a lot of the time, at the same time, like back here, that the euro was diverging here on the 4 and 6 hour charts back here, just in February, it was also diverging on the likes of cable. So, you then get multiple divergences across other currency pairs as well. But anyway, so this is the one that I'm talking about over there. So we've had a divergence here. We've had, and this is within a trend here. It's just a pullback within a trend. So not every divergence is, outright, a counter trend, so to speak. There were no divergences for the euro back down at this low. Not every low or every high is going to have a divergence. There were no divergences in the euro down at that low. So there was no divergence at that point. So at the moment, right now, we can see the euro as of today is pulling back. Okay. So what would I be doing right now? I say right now, but over the coming days. Well, if the euro is starting to pull back here, it's had a little bit of a run to the upside. I'm looking overall, remember at the beginning of this presentation, that quarterly divergence is still very much in play. So I'm going to be looking to see if there's any divergences appear. They're not going to appear on the daily. It's not going to happen up here. Price would have to be right down here to be a divergence against that low there. But if I go down to a smaller time frame, like maybe the hourly time frame, maybe there at some point, let's go to an hourly chart, there could end up being a divergence. Oh, well, look at that. What a surprise. There may end up being a divergence on the hourly chart. This is live now. For those of you who want recent examples, here you go. This is real time now. In real time. What does the euro need to do? It needs to close back up at some point back inside those bands there. It may not happen. If it carries on going down, then the divergence will disappear, won't it? There won't be a divergence. At the moment, it's a potential divergence. We can see that at this stage live, the MACD line is higher at 0.2 here than it was over here in this zone of 0.1. So we're going lower. There's nothing for me to do because it's not a guarantee that this is going to turn around. We might just carry on going lower and then therefore the potential divergence disappears and the MACD comes lower. So you don't try and preempt it. That's why we wait for a big up bar closing back inside the bands. Stop loss is then always below the most recent low. So if, I don't know, I won't be up, but that late. But if this was to close back inside the bands at some point by tomorrow morning, I'm going to be having a look at that. Because it might just drift its way back in overnight, close back inside the bands. I'll be looking, providing this divergence is there at that point and it's not disappeared, because that could happen, and the MACD line goes lower than over here, well, then there's no divergence. Do you see what I mean? But you have to get your eye in for these. And this is why you're going to need to go back over this webinar, because like I keep saying, I was saying at the beginning, what I'm going through, most people are not going to take it all in. They're not going to remember everything in in one hit. You're going to have to go back over it. But and like I've said, I'm trying to teach stuff that really I would teach over a period of 10 hours. But at least you're getting a bit of an idea here. Darren, do you measure the divergence from the wicks or the candle body? Well, it doesn't really overly matter, but just remember that the indicator itself down here is based on the closing prices. So therefore, in the main, you're looking at the closing prices. Yeah, but provided when price comes down, like it has done here, that it's made a new low here below the previous lows, then we're potentially on for a divergence if we close back up inside the 2-5 EMAs. Yes, Kevin, you do need the MACD lines to touch. So going back or cross, yes, touch or cross. Going back to that hourly chart, we can see that from point 1, we'll take this one as point 1 over here. The MACD lines cross to the upside, then they've come back down. They've at least touched, they've gone through it, so that's fine. We get a big tick in the box there. So yes, absolutely. Thank you for that question. Good. Right. Let's go back to this. Now I'm going to go through some other historical examples. Oh, could I repeat? No, watch the recording. I need to move on. So, some why they have to touch. Oh, sorry. Right. It all comes from my testing that I did over the years, Johan. So yeah, they don't always have to. You could have a situation whereby, let's go back to maybe the daily chart here. I need to find an example now, and I won't be able to find one now. But you do have situations where, okay, I'll just draw it on, where you've got your price has come down, made a low, bounced, and then come down to a new low over here, and then close back inside the bands, let's say. And so the MACD has done this. So, and it looks more like this. And you've got your other line below it down here. And it's not crossed. It's not crossed back down here. But essentially, the MACD is still higher at this point 2 here than at point 1. So it is still diverging. It's a personal preference of mine, Johan. As I said at the beginning, I'm showing you how I trade these and how I have historically traded these. So it's just that preference, and it's what I've always used as a rule. So coming back to trading within trends, I'm just showing you, even within this short-term daily trend at the moment, that bottomed, the price made a low back here in April. I think it was the 16th of April, something like that. And it's been going up. So within this is now a bit of a trend to the upside on the daily chart. So within this, the potential on a pullback to go down to the smaller time frame, as I've just shown on the hourly chart, is there to identify if there, and see if there becomes a divergence. It may not happen, but it just so happens as we're going through this live, there might be one there. Now, and that's exactly what I've already pointed out over here. When there was that hourly divergence back then into early December, over here, it was actually, this wasn't at this point, a trend overall to the upside. It was started trending down here, but still into technical support level. So again, at that point, we had the 6 hour, the 8 hour chart, 8 hour divergence, maybe the 12 as well, divergence going on at that point into February. So again, there was still reasons and rationale to warrant, if a divergence comes along, to say, yes, I can trade that. I'm going to show you some old examples again, just because they're bigger time frames, they're easy for me to go back to. If I now show you, for example, the dollar CAD here. This is on a monthly chart. At this point, when price came back to this is the 50 period on the moving average here, 50 moving average here on the monthly chart. This 50 period moving average was rising. Price is the first pullback into a key moving average. What was it doing? Funnily enough, it was diverging on the smaller time frames at that point. And yes, I traded that. At this point over here, it did a 3.5 month pullback on the, I think it was on the daily charts at that time. It was diverging. Guess what I was doing? Buying this. When was this? Back in 2015. Giving all sorts of examples here on all sorts of time frames. So I'm showing some big picture stuff because it's easy for me to go back. And I remember those bigger picture setups. I won't remember every 1 hour time frame setup that happened back in 2015, for example. So anyway, that's where we are. So we can overlay analysis first. Analysis always comes first. Support, resistance, identifying levels, and then saying, okay, or trends, and then saying, okay, we're in a trend and we're pulling back within a trend at the moment. Okay, if a divergence materializes, can I trade it? Otherwise, if there's not a trend, then can I trade it anyway if price comes down into support or up into resistance? Yeah. There's a lovely example of this one up here, for example. This one in middle of last year. I've already showed it earlier, but we had this divergence here on the weekly time frame, and I didn't actually use multiple time frames for this one. So, but certainly there's been divergences historically going back here. I traded this one. Why did I trade this one? Going into the end of 2020. Well, we got a divergence building on the weekly chart at that point, and right in amongst all that price action up there, there were divergences on the 4-hour chart as well. So I was using the 4-hour time frame to get me in December of 2020, knowing full well we had this developing divergence on the weekly. And where did I run it down to? Actually, I did just run it down to the 50 on that in that instance. In the end, it bounced and then rolled further. But for me on that instance, because I'd run it off the 4-hour or taken it off the 4-hour chart, the risk reward was awesome. So they happen all over the place. And that was into, as we can see, historical resistance. If I just take us out, I've just taken us to a higher time frame now. Yeah, here it was, into that trend line, long-term trend line at that point. So again, I've traded that end of December 2020, coming into the beginning of 21. That was where it was, into that resistance, big trend, long-term trend line. All right, okay, and so on and so forth. So that's how you can use them. Multiple time frames. Analysis comes first, then drill down to the smaller time frames and see if you've then got divergences taking place. No, that's not true, Dan. You just don't understand it. The crosses in the MACD, that doesn't matter about them being lagging. Okay, so let me give you an example. Okay, Dan, right. My apologies. I shouldn't have said that. So I was being confrontational. And so let me explain to you. So the crosses. So let's go to, it doesn't matter about them being lagging. Right. This is where I'm saying I don't think you understand. So let's use this example, this live example right now. I don't need to wait for the cross. The cross just needs to have happened. So it needs to have happened in order to give me a setup. Then it's all about price. I don't need to wait for these to cross back up. That would be lagging. Absolutely. That's not what I need to happen. All I need to happen is for the MACD lines to cross or touch over here, and then price come back up inside the bands. I'm not waiting for a cross, and that's where I said I don't think you understood. So I've been trading these for a long time. They are not lagging. The MACD signal lines, like any indicator, most indicators are lagging to some degree or another, but that's not how we're using these. We're not waiting for these to cross back to the upside. I often get people say, oh, if you wait for a cross to the upside, could I just do that? Well, you could do, but by the time these cross to the upside, by the time these cross, back to the upside, price might be way up here. So you're then getting in quite late. So, yeah. So, no, they're not, you're not waiting for the indicator to cross back. Okay, it's just price then. It's all about price then. Do you use that type of strategy, multiple windows, timeframes for divergence trading, or are you? No, I don't have multiple windows open, Irish. No. Yeah, back in 2011, you're talking about intraday trading, and so I would have the 5, the 15, the 30-minute, the hourly chart all open and the same thing. You can do that by all means, when you're doing your analysis, but that's not what I do because I'm mostly swing trade now. So I don't need to have that. But so yeah, you could do that if you wanted to have them all up together. I just change my time frames around. I quite like having a singular big chart, if you see what I mean, rather than making them into smaller. But if you want to do that, it's fine. Yeah. Is this only for Forex? Sorry, I'm trying to come back up to some of the questions here. No. You can use it on anything. Some of my traders actually, Chaz, use it quite a lot on stocks, US stocks. They're using it on, for swing trading. But I don't know about intraday, but yeah, they're using it on stocks. I will use it on the likes of the S&P. You can use it on gold. You can use it on whatever you like. It's just that I'm just trying to use examples here tonight on trades that I have taken, and it's just easy using in the main a singular market. So I've just used the euro for example here tonight, but yeah, you can use it on anything. Right, I think I've probably frazzled some of you because there's a lot in this. Like I said at the beginning, there is a lot in this. There's a lot of little rules and, analysis and time frames. And so I really do appreciate, like I said at the beginning, you're probably going to need to watch this again. You'll need to get your eye in. You'd need to do some testing on it as well. And again, and find a way of how you want to test it. I've shown you how I enter and where I place my stops. I do get stopped out and nicked out, and I just then get back in once price closes back inside those 2-5 EMAs again. Whereas other people might want to have a wider stop, and they're still going to have a wider target. So they might say, well, actually, the risk reward is still fine, but I get stopped out less. That's fine. I just like aggressive stops because I really like, when I get the big risk rewards. But again, there are so many ways you can personalize it and use it in conjunction with whatever your style of trading is. That you might say, do you know what? There are certain elements of this. I'm not going to use all of it, but there are certain elements I could incorporate with my own way of trading. And that to me is the ideal way to trade, is to personalize whatever it is. So I'm showing you how I've used this over the years, and I continue to use this to this very day. But it's nice that people say, right, I'm going to tweak that. I'm going to look at this. I'm going to look at that, this element, that element. And, do you even need to have the 2 MACD lines down here? Maybe not. You don't. Do you even have to have them cross, as someone said. Well, maybe not, but that's what I do. And that's how I'm showing it. But could you change the MACD settings and not have the standard 12, 26, and 9? Maybe. Maybe you have them more aggressive. Maybe you have them less aggressive. So there's lots of things that you could do with it. So I feel that my job here this evening is just to show you what I do with it, and you can do it out of the box, pretty much watch the webinar back and integrate it into your own trading with the same sort of rules. Or you can then go and personalize it. So there you go. Just going back over any other questions here. Right, the strike rate. Okay, based on your, hold on a second, Alan, there's more questions above yours. You got me confused with the not need to cross explaining in real time. Johan. Yeah, that was about, okay, we've got a potential divergence here for the euro at the moment. Okay, there's a potential, yeah, on the hourly. Remember, we've just gone through this a short while ago. So what I was talking about is that if price starts coming up, as price starts coming up, the MACD lines will start doing this, yeah? And what I'm talking about is that you don't need to wait for them to cross back up, because by the time they cross back up, price could be miles higher. So that's what I meant, where you don't need to wait for them to cross up in the direction of the trade that you're looking at, the divergence itself. They don't need to. So you've got your divergence as long at this moment, provided the blue line at this point is higher than the blue line at this point down here, and price closes back inside the bands, then that delivers a divergence. Right. And if you still don't get it, you're going to need to just keep watching the webinars, because I'm going to be saying the same thing. Based on your experience on which cross this strategy works best. I look for a cross or a touch, the blue line coming back to its average line. So it can just come back and touch it, provided then the price closes back inside the bands, then yes, it gets a tick as a divergence. So that's what I'm looking for. So that's how I trade them. There's a secret in that. That's how I trade it. Why? Because that's, from my experience, is personally the better way to trade it. Right. What's the strike rate? Okay. What I tend to do, Alan, when I'm back testing something, I don't take every single divergence. So to say what the strike rate is almost irrelevant, because again, I'm coupling up divergences in line with my overall analysis and support, resistance and stuff. You can't really back test that because I'm using multiple analysis points, you see. So it's not as straightforward as that. I don't trade, like I said at the beginning, you're not going to be taking every single divergence. You only want to be taking divergences which come with a story around them, i.e. trading into support, trading to resistance, or within a trend. However, whenever I back test a strategy, I will back test it in a vanilla sense. So back testing it with every we're back testing it with as if I was going to take every trade. I don't, because I only want to trade them, as I've already said, when they're in line with other stuff. But when I have back tested them, then the strike rate will vary depending on the stop loss, Alan. So for example, with a 3 times like ATR based stop, the strike rate was up in the 60s and 70%. So it was quite a high strike rate because it had a wide stop loss. So for me, what's more important is overall profitability, not strike rate. So I would rather have a lower strike rate or lower win rate, but have overall more profitability because the risk reward is higher. So I would rather have a tighter stop loss. which would then give you a lower win rate. Then you'd be looking down in the 40s. Okay. But who cares? It's about profitability. Right. Does convergence and divergence of the MACD signal lines can be used as leading indicators? No, I don't really use them for that. So no. Chaz, you're saying this is brilliant. Well delivered. Thank you. Kevin, do you use MACD divergence over a long time period when there are lots of highs and lows on price in between? Oh, yeah, if we go out, if we go back out to this quarterly chart, there's this is over a long time period where there's lots of highs and lows. I think is what you mean. If I take all the lines off, it's still a divergence from this point here to this point here. It doesn't really matter too much about what was going on. So I'm just looking at measuring two low points here from here to here. Is this point here lower than this point here? So it doesn't really matter what's gone on in between. Yeah. Please share your email. No, I can't do that. But you can check me out if you want to. You can come over to my YouTube channel. Actually, you can always send messages via my YouTube channel, but don't think you can just send messages asking countless questions, because I just can't answer technical questions on that. But do come and follow the YouTube channel. I put usually 2 videos a week up. I'm only doing one this week, but usually it's 2 weeks or 2 videos a week. There you go. That was the last trade video I did just last week, 5 days ago. The best thing I ever learned in trading. So, and there's always different topics that I cover off in on the YouTube channel there. So that's just Charlie Burton Trading on YouTube. So you can check me out over there if you want to get in touch at some point. I don't offer out my email, sorry. Thanks, Maria. Thank you, Blair. Thank you, Matthew. Johan, you've got it. Great. Excellent. Will we get the webinar as you missed the beginning, sadly? Karen, I don't know. You'll need to get in touch with Tickmill. But what I did say at the beginning, Karen, you would have missed it, is Tickmill are putting together a little microsite with me. And all of my previous webinars, obviously including tonight's one, will get logged, will get put onto there. So that's going to be up and running in the next 2 to 3 weeks, I'm told. So by the time we get to the next webinar, mark it in your diary. The next webinar, I'm just double checking now. I've got it in my diary. I'm just having a look off screen. It's in June, of course. 20th of June, Thursday the 20th of June is the next one. So certainly by then I'll be able to tell you about what the website is for that. So that is coming. So it will, all the past webinars will be on that micro site, but you'll need to ask Tickmill and your broker at Tickmill about all of that. Yes, exactly, Alan. Finding the balance. Indeed. You're a fan of adding to winners. Yes, I am. How would you do that in the context of these examples? H, we're sort of out of time. We're already an hour and a half into this. Unfortunately, adding to winners is another presentation that I'll have to do for you. So we'll do that one in a future presentation, if that's okay, because it's... I can't do that justice in 2 minutes in answering your question. You're saying thank you. What's this? Saber, this was really useful. You already realized this stuff, which I did not know, called divergences, but did not know when to enter the trade. Thank you again. Need some sleep on this one. Yes, exactly, Johan. Yeah, it does. You can't expect to understand a whole pattern and all this process, all in one session. So, like I said right from the beginning. Thank you, AJ. Another valuable session, you're saying. Thanks for sharing the knowledge. That is very kind of you. Yeah, check out Tickmill. Do that. Thanks, Alan. Sean. Thank you. Some people I can't pronounce your name, so apologies on that one. But lots of thanks coming through, so that's really nice. Your brain is fried, Richard. Good. Good stuff. Yeah. The thing is, Richard, it's easy for me because I've been doing this stuff for years. All I've got to do is try and explain it. But for you trying to understand it in one go, like I said at the beginning, this is 10 hours worth. Trying to squeeze it into, as it's turned out, an hour and a half. I knew it would be slightly longer. So yeah, the recording will be made available. Go to Tickmill, ask them, pester them. But it'll take them several days before they've even got the recording. So, but do get in touch with them, asking them for it. But like I said, and then this microsite, by the time we do the next webinar, the microsite will be up and running. There seem to be some good traders here, Charlie. How would one connect for each one, teach one? I don't know what that means. Thanyani, there seem to be some good traders here. How would one connect for each one, teach one? I don't know what that means. And you put LOL, so I don't know. Thank you, David, Jay, William, Jimmy, Alan. We'll check the YouTube channel. Okay, yeah. And the pound dollar you gave us on fake out played out well. Oh, right, okay. Well, actually, the fake out webinar, there was something else I was going to mention on the fake tonight about last month's one, because I was talking about something in the fake out, wasn't I? And I've forgotten what it was now. Pound dollar. Let's see if I can remember it. Oh, yes, of course. The fake out. Yeah. Pound, multiple touches up here, did the fake out up here, came down here, took out all the last lows. What's it been doing since? Coming up. Yes. All right. It's down on the day today, but yeah, exactly. Good stuff. Now, Alosi, you've got other people thinking, oh, what's this one? I need to know this one as well. So, okay, right. I'm going to leave you to it. Thank you ever so much for all your kind comments. And the 20th of June will be the next webinar. Enjoy the rest of your days. Enjoy the rest of your evenings. That's me pretty much done. And so thank you for sitting there through tonight's session.